Good morning. My name is Vladimir Tikhomirov. I'm Chief Economist at BCS Global Markets, and I'll give you my outlook in the macro area for the coming week. The past week has been quite full of events. In particular, I would note two areas. One is the new statistics on Russia that came out, and the second one is the political area. In the statistical area, Росстат, Russian Statistical Agency, has reported two key indicators for the economy. One was GDP numbers for last year. GDP, the fall in GDP came out significantly lower, significantly smaller than we projected, and the market consensus expected minus 3.1% year on year versus 3.6% that we forecasted. The reason behind better statistics basically is related to the change in methodology. Росстат has increased the share of non-resource segments of the economy, including manufacturing industry, and cut the share of oil and gas and resource industry in the GDP output. That was driven by the change in the base year for comparisons, but that also led to far smaller negative effect from the slash in oil and gas prices last year on GDP performance, and that in our view explains why GDP numbers came out better than anticipated. The second portion of statistics was related to inflation. Inflation data for January came out at 5.2% year on year, slightly lower than we expected. We were expecting 5.3%. However, again, what Росстат reported last week was a change in the consumer basket that it uses for calculations of inflation. In this basket, Росстат has increased the share of foods and decreased the share of non-food consumer goods and services, which basically resulted in zero weekly inflation in the last week of January, which was very, very unexpected given the seasonality. Normally, we see high inflation pressure traditionally during this period of the year. Going forward, we actually expect inflation to keep on growing for another couple of weeks, perhaps 3 weeks, until end of February. In March, we expect inflation, annualized inflation, to stabilize before it starts coming down at the last days of March and in April. The reason here is the base factor effect. This time last year, inflation was coming down quite significantly until mid-second half of February, and then inflation from March started to grow. And particularly the rate of inflation accelerated in April. That could be the major trigger for expected shifts in annualized inflation in the coming 1 or 2 months, something that we expect, the market expects, and the central bank expects. If we don't see any major moves in the ruble rate, and I would like to note here that the ruble rate actually has effect on inflation with 1 to 1.5 month lag, because it affects the prices of imports. If ruble keeps on growing or stable, but does not weaken, potentially it can weaken if there is a highlighted geopolitical risks, then chances are that inflation would start coming down in 2 months from now. That is something that the central bank is likely to wait for, and therefore we don't expect the central bank to make any changes in its policy, including the rate, when it meets on the 12th of February. We expect the rate to remain stable for the next couple of months. the central bank would be tempted to wait to see what happens with the inflation trend in the coming months. If things go as planned, chances are that there will be no changes in the rate during spring months as well. If for whatever reason inflation does not come down as significantly as expected, central bank might discuss a possibility of a rate hike, but no earlier than April in our view. Another area where we have seen quite a few developments last week was in the geopolitics and politics. In Russia, we have seen new attempts by authorities to clamp on opposition. The new court case against opposition leader Navalny continues. That creates more pressures on Russia from various quarters, including Europeans and US. Last week we have seen first in a few years official visit by European Commissioner for Foreign Affairs Borrell to Russia, and of course the discussions of domestic politics and authorities moves against opposition were one prime topic during these discussions. We have also heard continued sanctions talk from Europe and US, although there were no concrete measures announced thus far. In my view, this means that the geopolitical risk related to Russia remains quite high, as it were in the previous weeks. And that would keep putting pressure on the future ruble moves and on the market moves in the coming weeks as well. Just to give you some idea, with the oil at $60 per barrel now, more or less, last time we've seen such levels was in January last year, but then ruble rate was around 63 rubles to the dollar. Now ruble trades around 74 rubles to the dollar, and the large portion of this difference is related to the geopolitical risk. This risk is very significant factor on the Russian market. The risk might come down if and when we see new sanctions being announced by Europeans and US. If the sanctions are related or limited to expansion of lists of specially designated nationals, personal sanctions, then that could be seen by the market as a positive trigger because there are no significant economic sanctions reported. However, the risk is that there could be some economic sanctions reported. If that happens, we could see more negative pressure on the market and the ruble. Thus far, we expect ruble to continue to respond modestly but positively to the oil price moves. So we don't rule out that in the coming week or so, ruble can actually enter the corridor of 73 to 74 rubles to the dollar versus 74, 76, where we saw ruble trading over the past couple of weeks. That's perhaps all on my side. Thank you.